Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Been a dizzying week of news flow with FOMC, jobs, and big tech earnings. A lot of uncertainty has been cleared up. One last bit of news we're waiting on: how many Olympic triathletes got sick from swimming in the Seine? I guess we'll find out. Anyway, this week our three things are: 1. Spread compression. Does this make sense heading into slowdown? 2. Abundant liquidity. One asset manager says credit is overbought as a result. We'll explore. And 3. Texas downdraft. This caught us by surprise. All right, let's dig a bit deeper. Spread compression. I don't have to tell you that the monetary transition from massive quantitative easing from 2009 to 2021 to suddenly restrictive starting in 2022 has been a painful one for fixed income managers. And I don't have to tell you that getting to the other side of that change, where yields today are the most attractive in 15 years, and where the 60-40 portfolio once again makes sense, has been a boon of late to the credit asset class. And with the rates part of the credit yield equation representing a historically disproportionate share of returns, call it 80% or so of investment grade and 60% of high yield, you have to wonder if markets have gotten complacent with regard to the credit portion of that equation. Now, looking backward, the answer is clearly no. Against conventional wisdom and history, we seem to have achieved immaculate disinflation. The economy has been growing well above potential. Unemployment has remained quite low, and corporate earnings have recovered nicely from the inflation shock. And inflation, of course, is moving convincingly toward target. All of that suggests that credit spreads should be tight and compressed at this point in the cycle. And they are. Both investment grade and high yield are well through long-term averages, as are rating category differentials. Triple Bs are just 33 basis points wide of single As. The long-term average, by the way, is 58 basis points, while high yield is just 215 basis points wider than IG compared to that long-term average of 343 basis points. But now we're seemingly at an inflection point, and the narrative is changing from holding down inflation to slowdown, from higher for longer to rate cuts. This naturally begs the question, should your positioning change along with it? Now, the first consideration is, just how material is this change? We've made the case that it shouldn't be all that dramatic. Within our two economies theme, we remind folks that the cohorts doing well, wealthier households and larger businesses, clearly are carrying the day in terms of the aggregate data. That's where we get soft landing. So much in the credit risk opportunity set still makes sense from a fundamental standpoint. Add to that two positive technical factors. One, expected rate cuts, which will be unusually meaningful given the importance of rates in your returns. And two, reduced issuance expectations in the second half of 2024. The latter takes into account record-setting issuance in the first half from treasurers trying to get ahead of election season volatility. So it makes sense for buy and hold investors to largely stay the course across the risk spectrum, as all but the most vulnerable credits should be able to withstand slowdown as long as we avoid recession. And on that point, to the extent you believe in the wisdom of crowds, we remind listeners that one-year recession probabilities stand at or around 30% in both Bloomberg and the Wall Street Journal surveys. For active managers, this is an opportune time to selectively move up in quality, selectively reducing riskier and more cyclical names and sectors. All right, on to our second thing: abundant liquidity. In Oaktree's Performing Credit Quarterly for the second quarter of 2024, there's a meaningful amount of attention paid to liquidity. More specifically, how abundant liquidity, that's stimulus-fueled, has put upward pressure on prices in most asset classes. The authors believe that the deployment of this concentration of wealth, found on the balance sheets of wealthy households and businesses, has caused capital markets to be far more generous than they otherwise would be in an elevated rate environment. As a result, says Oaktree, many highly levered companies have been able to postpone potential problems by refinancing their debt into unsustainably or unjustifiably favorable financial conditions. Well, that's quite a leap. Here's how we would think about it. Now, there's no disputing that there was a surge in liquidity during the pandemic. Pull up a chart of M2 on your Bloomberg, and you'll literally see the bubble, a 42% jump in the money supply from the beginning of the pandemic to April of 2022. That money had to go somewhere. But did it all go into risk assets? The answer, of course, is no. It's no great revelation that some of it went into treasuries and some went into money markets. That's the all-time high of $6 trillion in money markets you often hear referenced today. But we disagree with the implication that risk and reward have broken down, and that investors have overbought and overpaid for credit assets, simply because they could. If that were the case, you wouldn't have record levels of very low-risk money market assets or 10-year Treasury yields through 2-year Treasury yields. Riskier credit assets are well bid because the economy has performed much better than expected, which means lower recession risk, and that means lower default rates. And of course, the rate rise has made credit yields highly attractive. Here's the other important development. We've talked a lot about how the cost of capital has increased materially over the past 2 years, in large part because the cost of debt has risen materially due to the Fed's rate hikes. That means that achieving an acceptable rate of return has become, appropriately, more difficult. Accordingly, company business models and capital structures will be subject to greater scrutiny than has been the case for much of the past 15 years. And that is sure to usher in the return of capitalism's creative destruction. Now, to be fair, Oaktree ultimately gets around to this point. To quote, "We believe credit investors should proceed with caution and avoid assuming that major concerns about corporate credit are all in the rearview mirror." Unquote. On that, we would agree. All right, on to our third thing, Texas downdraft. We might very well be guilty of regional bias here, but those of us in the Northeast have long viewed Texas as a model of translating sensible economic policy into economic growth. So we were more than a bit surprised this week with the latest regional update out of the Dallas Fed. Sure, we're set to slow nationally, but after the Q2 GDP report where the growth rate doubled sequentially, we thought we'd see solid numbers out of the Lone Star State. We got that wrong. The Texas Manufacturing Outlook Survey conducted by the Dallas Fed remains depressed. The data is collected monthly, and diffusion indices, that's where increases less decreases are tabulated, was created across a number of factors. Although manufacturing production levels have been holding relatively steady over the past couple of years, the outlook level of general business activity was negative. That's where more survey participants cite worsened than improved for the 27th consecutive month, the last 18 of which are double-digit negative. The outlook for the respondent's particular company was also negative for the 29th straight month. New orders dropped 12 points in the latest survey to a negative 12.8, signaling a renewed pullback in demand. Also of note was just 12% of respondents reporting raising prices in the most recent month. That's down from near 50% back in the inflation rise period of 2021 to 2022, and reflective of the fact that businesses are running into pushback from their customers on price hikes. Now, Texas looks like a leading indicator for what's happening nationally based on this week's IMS manufacturing survey, which came in well below already depressed expectations, reflecting softening demand. A separate Dallas Fed survey for services isn't much better, although optimism about the future is on the rise. The outlook for general business activity has been negative for 26 consecutive months, although the most recent result, virtually balanced between improved and worsened, was the best over that time frame. Respondents' expectations regarding future business activity jumped 16 points in July to a positive 19.1, its most optimistic since February of 2022. Other future service sector activity indexes, such as employment and capital expenditures, remained in positive territory and increased, reflecting expectations for growth in the next 6 months. Taking all that into consideration, it sounds like a few rate cuts are in order. So there you have it. 3 things in credit. 1, spread compression. We're not falling off a cliff, but the cost of moving up in quality is rarely this cheap. 2, abundant liquidity. Just because you have a lot of money to put to work doesn't mean all investing discipline is lost. 3. Texas downdraft. In manufacturing and in services, we're seeing the bite of monetary tightening. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We're kicking back next week on holiday, so look for our next 3 things Friday the 16th. We'll see you then. Hello, listeners. Join me, Van Hesser, KBRA's chief strategist, for in-depth conversations with credit experts in my new monthly podcast, Leading Voices in Credit, where I'll interview market professionals on the latest trends in credit markets. That's Leading Voices in Credit with Van Hesser. Subscribe now.